welcome back to Three Clowns, episode 21, Monday, May 4th. We've got a split tape to sort through. Apple dragged the Nasdaq higher on Friday, while the Dow went the other way, and then over the weekend, GameStop apparently decided to bid $56 billion for eBay, which is either the most bullish or most insane thing we've heard all year. Tom, Ray, let's dig in.
Yesterday, I spent 10 minutes apologizing to a chair because I thought it was a person in a hoodie. It accepted the apology better than most people do.
Honestly, Tom, I'm just impressed you were still being polite to inanimate objects by yesterday afternoon.
Okay, so Friday we got the split. Apple crushed earnings, dragged the Nasdaq up 0.75% on the back of a 3.3% move in the stock, but the Dow still couldn't get there, ended down 0.33%. Pre-market this morning, it's the same story over again. The QQQ's up 0.25 point, the Dow down roughly the same. Energy completely sold off Friday, even with Iran fears still in the air. Crude down almost 3% overnight on Iran de-escalation hopes, and Trump saying the U.S. will help ships clear the strait, so the wartime premium that was bid in basically evaporated. Although prediction markets on Kalshi are still pricing a path to $125 oil if the conflict drags, so nobody's fully standing down. Speculative beta caught a bid though, silver up 2.5%, Bitcoin up 2.2%, and MicroStrategy ripping up 7%. There's also a hantavirus outbreak reported on a cruise ship, 3 dead, WHO confirmed, which should weigh on travel names at the open. And AI energy funding stayed hot over the weekend. A European battery company hit unicorn status, raising €50 million specifically for AI data center power demand. And then you've got GameStop apparently trying to buy eBay for $56 billion, which I genuinely cannot tell if that's visionary or if we're just watching the meme economy eat itself on a full loop. Big week ahead ISM. Services tomorrow, ADP Wednesday, NFP Friday, with consensus at 73,000 jobs and unemployment holding at 4.3. Tom, the Nasdaq up, the Dow down. Is this the healthy kind of split or the worrying kind?
It's the worrying kind. When it's basically Apple doing the group project and everyone else is eating glue, that's not leadership. That's concentration risk with a nice haircut. I get the quality rotation argument, but if one of those names sneezes, the whole thing moves 3%. Ray, you buying that this is healthy?
It's a bit of a Frankenstein market. People are piling into Apple for safety, but then immediately throwing those chips at silver and Bitcoin, which tells me they aren't actually scared, they're just bored and over-leveraged. It's not healthy, but it shows there's still way too much liquidity sloshing around for a real correction to stick yet. Alex, what is the actual deal with this GameStop bid? Is there any real paper behind $56 billion?
Look, GameStop's market cap is around $8 billion, so the math on a $56 billion bid is, that's either a stunning amount of confidence in their balance sheet or it's pure theater to keep the stock in the conversation. Either way, we've seen weirder in this cycle, so we're not ruling it out, but yeah, we'll dig into all of it. Let's get into the tape and figure out what actually moved money on Friday. Okay, so let's cut through the noise here. Friday was really two markets trading at the same time. Apple reported a beat that actually mattered. iPhone revenue held, services printed money, and the street immediately repriced the mega-cap tech narrative higher. That 3.3% move in Apple single-handedly did the heavy lifting for the Nasdaq, up almost a full point while literally everything else either flatlined or went backwards. The Dow couldn't get there because red financials and industrials just completely underwater. Energy, especially, got hammered. Crude down almost 3% on the back of Iran de-escalation chatter overnight, and Trump basically saying the U.S. will run a shipping escort service through the strait, which killed the war premium that was bid in. So here's what's weird. Apple crushed it. Rates feel stable, earnings are actually showing up, and yet the breadth is narrowing hard enough that if you squint, you're basically watching one stock drag an index. But then, and this is the part that breaks your brain, you've got silver up 2.5, Bitcoin up 2.2, MicroStrategy ripping 7%, which tells me the market isn't actually scared about concentration. It's actually overleveraged and bored, just spraying beta in all directions. This speculative bid alongside the quality bid living in the same Friday doesn't add up unless there's just too much cash looking for a home. Tom, I want to know, did the wartime premium actually exit the building on real news? Or is this energy bounce just setting up for a head fakes when we get another headline out of the Middle East?
No, they just took the sticker off and left the dent. An escort headline doesn't reopen supply, it just lowers the insurance quote for about 6 hours. The actual risk moves, retaliation cycles, miscalculation, that's all still sitting there, unchanged. And you had positioning stretched, energy ran, people had gains, they hit the button the second a de-escalation word showed up. That's not fundamentals improving, that's traders paying themselves. If this thing dragged even a week longer than expected, that premium walks right back in like it forgot its keys. Ray?
It's like watching water find its level. When that war premium drains out of crude, that liquidity doesn't just vanish. It rotates instantly into things like silver and Bitcoin because the market's fundamental hunger for risk hasn't changed, only the vessel it's sitting in. Yesterday I was looking at the cross-ass flows, and it's clear we're just swapping one volatility play for another, which means the GameStop and eBay headlines are going to make this morning's open incredibly noisy while the real money tries to find a footing. Alex, do the internals on that Apple move actually support a broader rally, or is the rest of the index just drafting?
Yeah, the internals are basically screaming no. Friday's advanced decline was negative, even though we closed the Nasdaq green. That's the textbook definition of a narrowing rally, not a broadening one. 2/3 of the index went backward while Apple dragged everything across the finish line. You look under the hood and it's not healthy, it's just momentum in the names that matter most, which means the market is essentially betting that Apple can hold the whole thing up by itself. That's not a thesis, that's a prayer. And look, GameStop and eBay are going to be absolutely chaotic at the open. Today you're going to get retail noise, some short squeezes probably, the usual meme energy getting sprayed around. The real question is whether that cascades into the rest of the tape or stays perfectly isolated, because if it bleeds, that tells you something about how desperate people are to find anything that moves. So here's where we're at. Apple works, earnings work, but the structure underneath is rotten. Ray, walk us through the footnotes. What's the Fed actually signaling underneath all this noise?
Alex, it's like we're all standing around praising the new wallpaper in the living room while the basement is still very much on fire. Yesterday, I was digging through the Fred charts again, and that PCE at 3.5% is just, it's sticky, man. Everyone sees the energy ETF and crude dropping on this Iran de-escalation news. But then you look at the gas pump and it's $4.39 a gallon. That's a 47% jump since the conflict flared up. The equity market is trading the headline, but the consumer is trading the reality. And Kalshi is still pricing in a $125 oil scenario if this drags. The Fed is genuinely stuck because the 10-year yield is already at 4.37, and if they hike to kill the smoldering inflation, they might accidentally smothering the AI growth narrative everyone is leaning on. We have to watch Tuesday's ISM Services, specifically that Prices Paid subindex. It was over 70 last time, which is basically a siren going off for service sector inflation. And if Friday's jobs report comes in hot, way above that 73,000 estimate, the rate cut dream is officially dead for the year. Oh, and keep an eye on the cruise lines today. There's a confirmed hantavirus outbreak on a ship. 3 dead. It's just one of those weird footnotes that hits sentiment when people are already looking for a reason to sell travel. Tom, do you think the market is actually buying this de-escalation, or is it just a liquidity flush before the next leg up in oil?
They're not buying it. They're using it. First, believable headline and every crowded energy long just hits the bid at once. That's not conviction. That's inventory management. The tell is Tuesday. If ISM Prices Paid stays hot, oil can drop $10 and it won't matter. The Fed story breaks anyway.
Tom, you're hitting the nail there. And that 70.7 reading from last month is it's a massive outlier if you look at the historical trend. Because if we only add 73,000 jobs while service costs are still ballooning, we're not just talking about sticky inflation anymore. We're edging toward the S word, stagflation. The Fed can't cut to save the jobs without pouring gasoline on the price fire. And the 10-year is sitting at 4.38 this morning. William speaks at 10 to 5 this afternoon, and I'm watching whether he even acknowledges that prices paid pressure. Alex, over to you.
Yeah, Tom's nailing it. ISM Prices Paid is the actual circuit breaker here. Because if that number comes in hot again, the energy news becomes noise, and the Fed's whole patient and flexible posture just evaporates. Then Friday's jobs number becomes the final word on whether they have any cover to sit still for the rest of the year. If we get both hot prices paid Tuesday and a beat on payrolls Friday, you're looking at rate cut expectations basically zeroing out, and that's when the AI rally gets a real headwind. So Tom, let's go to Nerd Corner. What's the structural story under all this? Where does the AI thesis actually stand if the Fed is forced to stay hawkish?
The structural thing. You basically got three waves happening at once, and everyone's arguing about the first two because they're easy to see. Chips, apps, and then the one actually changing the economy is power. Apple's print is the cleanest tell. Services were good, that's subscription, lock-in, people not leaving the ecosystem even if you beg them. That's not AI. That's habit with a billing system. Apple Intelligence exists, but it's not in the numbers yet. The market's giving them AI credit anyway because it needs somewhere large and stable to park that belief. NVIDIA doesn't need belief. That's just revenue showing up. Apple is still a very nice story about consumers who don't churn. Then you zoom out and go, okay, if AI is real at scale, what actually has to be true underneath it? Not apps, not chatbots. Electricity. Constant, boring, uninterruptible electricity. That's where the CMBO thing matters more than it sounds. Flow batteries, grid storage, data centers that can't have the lights flicker because someone asked a model to generate a logo. Hyperscalers are quietly locking up power the way they locked up GPUs 2 years ago. Nuclear deals, long-term PPAs, weird European battery startups, it's all the same trade expressed lower in the stack. Meanwhile, GameStop is bidding $56 billion for eBay. They're an $8 billion company with $4.6 billion in cash. So they're short about $51 billion, which is a rounding error if your strategy is vibes plus equity issuance forever. If that were real, it's a reverse takeover, where the meme buys the legacy platform and calls it a pivot. eBay isn't even growing. It's just there, like a digital yard sale that never closed. You're not buying growth. You're buying a user base and hoping the story outruns the math. So back to the Fed question. If policy stays tight, the application layer gets squeezed first because that's where expectations live. The chip layer holds up as long as orders are real. But the power layer, that just keeps getting built because none of this functions without it. The market's still pricing waves 1 and 2 like they're the whole story. Wave 3 is the constraint. Ray, are we underestimating how much of this ends up being an energy trade with an AI sticker on it?
It's even bigger than a hedge. It's a land grab because the hyperscalers have modeled the load and realized the public grid physically cannot scale to their compute projections. When Microsoft restarts 3 Mile Island or Google signs direct nuclear deals, they're building a private moated infrastructure because they know the energy constraint is the only real ceiling left on the model. Alex, are we actually pricing that utility scarcity yet?
No, we're not. And that's the gap. The entire AI multiple is sitting on chips and software, like those are the only two waves. Power infrastructure is completely invisible in the multiples, which means the markets essentially price this as if electrons are free and unlimited. Tom and Ray are right. Whoever starts pricing that scarcity first, whoever realizes the constraint is real and not a detail, they're going to front-run everyone else into the names that actually control the capacity. It's a 2 to 3 year edge if you see it now. All right, let's get to the calls. All right, let's score Friday's calls, episode 20, before the weekend. Tom, you called the KQQ's closing red, down about 1%. They actually closed up. Ray, you had the energy ETF rallying at least 1% by close. It closed down instead. And I called the Russell down 1.2% minimum, and it closed up. So, that's a complete reverse sweep. All three of us wrong, and all three of us wrong in the opposite direction we predicted. That's almost impressive. Scoreboard right now, I'm 7 and 11, Tom 6 and 12, Ray is 2 and 14. So we're all suffering equally, which is nice. Tom, what's your call today?
Apple closes red, down about 1%. It's the only thing anyone's actually selling while the rest cosplays strength. I'm wrong if it flicks green by midday and stays there because then the index drag story just dies. Ray, what have you got?
Betting against the fruit company. That's a bold move, Tom, especially when they're using that buyback as a shield. Well, over the weekend, I was looking at the Fred charts for M2 velocity, and it's clear the speculative fever is jumping from crypto into the metals. So I'm saying the silver ETF finishes up at least 2% by the closing bell. It's catching that sticky inflation bid where people want hard assets because they don't trust the Fed to actually hike again, so silver becomes the high beta version of the gold trade as liquidity sloshes around. I'm wrong if the 10-year yield spikes another 10 basis points before lunch. That kind of move in the interest rate plumbing just sucks the oxygen out of anything that doesn't pay a dividend. Alex, what have you got?
Silver and a risk on tape. Bold.
Ray, the M2 velocity into metal story is solid. That's the move nobody talks about until it's already happened. All right, here's mine. I'm calling the 20-year Treasury yield closes up at least 15 basis points from where it opened this morning. We're sitting at 4.378 on the 10-year. The curve's inverted, and tomorrow we get ISM Services. Everybody knows it matters, so the long end is pricing in the nervousness right now before the actual number drops. Bonds are selling off into the data risk. I'm wrong if we close the day and the 20-year is actually lower than it was at the open. So yeah, I'm betting the bond market stays spooked. Thanks for listening to Three Clowns, everybody. If you're not following the show yet, hit subscribe wherever you get your podcasts. It helps us stay on the air. We'll be back tomorrow morning before the open. See you then.